Good afternoon, ladies and gentlemen. Welcome back. Hope you enjoyed lunch. In this session now, we are going to focus on the global markets, the critical changes and future expectations for the key markets that are Italy, Europe, China, and Russia will be analyzed by our speakers. Now let me invite our first speaker, Mr. Jeroen Vermeij from the European Steel Association, or EUROFER in short.
İyi günler, baylar, bayanlar. So far, my Turkish introduction. This is where it stops, unfortunately. But anyway, good afternoon, ladies and gentlemen. Pleasure to be here in Istanbul. I would like to thank SteelOrbis for the invitation. Happy to be with you, which is, I think, the most important steel event in Turkey. I'll speak about Europe, the vision of EUROFER, and hopefully I will give you some new insights concerning what is an important trade partner for Turkish steel producers. It's apparently not working, but there we go. Okay, so I go back up. Okay, you've seen it all. But let's start. Start with the economic situation and economic outlook. First, a look at some indicators for Europe. The top graph are coming from the European Commission. This morning there were the new ones for November. Actually, there's no change compared to what we see here. We see a stabilization in indicators following the drop in the third quarter. Now, the drop in the third quarter was caused by increasing concerns about what was happening in the Ukraine, slowing growth in the emerging countries, regrowth in certain countries in Europe, particularly France, Italy. Now, these concerns have apparently diminished to some extent, and we see again confidence stabilizing. The bottom graphs, the right-hand one, comes from IFO, also a good indicator, particularly for Germany, of course. There we see the same sort of trend, a drop followed by a slight improvement, and the market PMIs for the Eurozone, the same positive trend again in indicators. One problem is remaining, though. The fact that within Europe we are seeing a significant divergence in terms of economic momentum. Spain, Germany, I've taken these two countries as an example. And to start with Germany, we see the continuation of robust levels of the indicator. Spain has made a significant improvement since 2013 that reflects the reforms that have taken place in Spain, reforms in the labor market, etc., fiscal regime. And currently, Spain is at the same indicator level as Germany. It's quite different in Italy and France. Those countries have continued to suffer, which I think basically reflects the fact that reforms have been too little, too slow. And these countries are definitely the weakest in Europe. So, what is the situation? What is the outlook for Europe? I think there are some positives. As I said, indicators improving a bit again. The latest data, Q3 data for economic growth, were positive. Reforms are really having an effect on the economies. We're seeing the first signs from the labor market. Employment has started to increase again in several countries. Oil prices have come down. Now, together with labor market improvement, that's good news for the consumer. Be able to spend more. The ECB is still continuing its very accommodative monetary policies. In some countries, the fiscal drag is easing. And we're seeing also in the banking sector the evidence of, let's say, easier credit standards, an easing supply in credit. Overall, also, of course, also the weaker euro is helping Eurozone exporters to export to countries outside Europe. So I think that's good news. Unfortunately, there are also some less positive news about Europe. In our trade, we depend to a significant extent on emerging countries, the BRICS, and growth in those countries is definitely slowing. Of course, there's also the conflict on the border of the European Union in eastern Ukraine. Things appear to have stabilized for now, but of course a further escalation of the conflict would have serious repercussions for the EU economy with regards to further trade sanctions from both sides. And as it is, because of the fact that in Europe most part of growth is still coming from exports, that is a sort of vulnerable situation. I mentioned France, Italy, two large countries within the Eurozone which are definitely underperforming the positive trend we're seeing elsewhere. As it is, those countries are currently trying to delay the necessary reforms. But of course, they actually need those reforms to catch up in terms of competitiveness and improve their economic situation. Overall, although the labor market is, let's say, showing some signs of improvement, unemployment in Europe is still high. It was already mentioned, a deflationary scenario, low growth combined with low inflation, that is definitely also a risk for Europe. And as it is, the EU is concerned about the security of its energy supply. So the risks are definitely skewed to the downside. Okay, let's go on to the steel-using sectors. The bottom graph on the right-hand side shows a very typical seasonal pattern we're seeing this year. We've seen very strong growth in the first quarter, but that's basically a base year effect. First quarter 2013 was weak because of harsh winter conditions in Europe. Now, this year we hadn't had really a winter, so there was a significant improvement. But for the rest of the year, we didn't see much of an improvement in the steel-using sectors. So 2014 growth is there, almost 2.5%, but it's mainly because of a base year effect in quarter one. For next year, we do expect that growth will be, again, a bit better balanced over the year, with continued growth from quarter one onwards. As it is, it will be driven by domestic demand and exports. This week, the European Commission introduced its 315 billion euro investment fund, which should definitely have a positive effect on investments in Europe. Investments related to transport, energy, communication, education. So we do expect a positive trend in investment in Europe again. At the same time, the weaker euro will definitely benefit exporters. Again, we do expect activity in the steel-using sectors to rise by slightly more than 2.5%. And as you can see on the left-hand slide, most sectors, basically all sectors, participate in its growth somewhat. Some will be showing somewhat stronger growth, others somewhat weaker growth. I included this slide because it's interesting to see where we are now compared to 5 years ago. This is the total growth over the period 2010-2015. 2010, let's say the first year where we saw an improvement after the crisis. 2015, the end of next year. Now, if you look at the graph, and particularly the left-hand side of the graph, you see Western European countries. Unfortunately, 3 of them, France, Italy, Spain, are actually expected to be, at the end of 2015, at a lower level than in 2010. So that means industry in those countries is still struggling to get back to even the 2010 levels, and the 2010 levels are again significantly lower than 2007, which was the peak of the cycle. On the other part of the graph, you see Central Europe, which is doing much better than Western Europe. We see strong growth there. But overall, due to the, let's say, the relative weight of Central Europe in total Europe, overall growth is going to be rather modest. I've selected two sectors to give a bit more detail. The largest sectors in Europe, construction and automotive. Construction, again, we see the very typical seasonal pattern over the year, a strong first quarter followed by hardly any growth, and then the expectation of better growth in 2015. In most countries, momentum in the construction sector remained very weak, particularly in large markets such as France, Italy, Spain. This year, nevertheless, there will be growth, again due to a good first quarter. What's positive, though, if you look at the bottom graph, you see there's a continued improvement in confidence in the construction industry. So that is providing some hopes for the business situation in 2015. And we do expect there will be a slow recovery again in the construction sector with a more seasonal, let's say a more regular seasonal pattern. Country by country, the situation will also be less divergent than we see this year. Looking at the key drivers, it's basically residential construction. Now that has a major drawback in terms of its steel consumption. If you look at steel consumption in residential construction, it's definitely not as important as the amount of steel that is going into non-residential or civil engineering. But nevertheless, we do also expect that those two sectors will show some improvement in 2015. The reason is that finally there will be some improvement in public investment. I mentioned the investment fund from the European Commission. But in addition to that, also at a country level, we're seeing many initiatives to increase investment, particularly the German government introduced a 10 billion euro plan for the next 3 years, only aimed at infrastructure projects. UK is doing projects, so there's definitely going to be a bit more momentum in this sector. Again, output growth around 2%, and particularly a good outlook for the UK and Central Europe. Automotive has been the, let's say, call it the star performer of the European steel-using industries. Continued growth in demand, passenger car sales, and commercial vehicles. Also, exports continued to develop positively. One concern, though, of course, the Russian economy is definitely slowing down, close to a stagnation. And particularly German sales to Russia have weakened in recent time. Overall, first half year growth was a bit stronger than the second, but nevertheless growth continued into the second half of the year. And that is basically what we also expect for 2015, a continuation of rather positive conditions in the automotive sector. Of course, there's again the concern about, okay, what could happen if there would be an escalation of the conflict in the Ukraine. Definitely one of the actions taken by Russia could be a ban on automotive exports from the EU to Russia. And now if you're a car producer with your own production facilities in Russia, that's not such a big issue, but if you don't have those plans, it is certainly a concern. Then also quite some cars are going to China, to Asia in general, and the slowdown there is definitely limiting exports. So overall the picture is a bit less positive than in 2014. Nevertheless, we do expect 3% output growth. Significant expansion of production in Spain, in Italy, Sweden, and again Central Europe in general. Germany, UK to stabilize because they have reached almost full capacity utilization. France, definitely the weakest country with respect to the automotive sector in Europe. What does it mean for the steel market in Europe? Much in line with the economic situation and the trend in the steel-using sectors, we've seen growth in the first half of the year. Unfortunately, we saw also growth disappear in the second half. Over the first 9 months of the year, we've seen a demand of steel, total finished products demand, growing by almost 4%. And much in parallel with what Mr. Yayan described this morning, it has been basically imports that have taken that increase of the market imports rose 21%, European deliveries just rose 1.5%. So we're seeing the same trends. There's a significant similarity in that respect between Turkey and Europe. Expectations for the second half of the year rather weak. There will be destocking. Real consumption will be rather weak. So we do expect a slight decline in the first quarter and overall some 2.5% growth in apparent consumption. As you can see in the bottom graph, the 21% is for total finished products. If you divide that into flat and long products, you see a significantly different picture. You see a 15% rise of imports in flat products, but almost a 45% rise in long products. For next year, we do expect a rather similar increase in steel demand in Europe. Real consumption, in line with what we expect for the steel-using industries, is going to rise moderately. Stock cycle, hopefully to be on normal. Overall, apparent consumption growing by 2.5%. And again, we do expect imports to remain at a high level. They probably would increase a bit, even compared to 2014. And that means that for European mills, the current margin pressure will continue. Again, very much the same as for Turkish mills. I've included the slide to show, let's say, our concerns about what's happening with imports. And again, there's a significant similarity presented this morning in Mr. Yayan's presentation. The fact that we're seeing so much imports has to do with an enormous flood of imports arriving in the EU. They're aggressively priced. But as it is not only the EU, it's also Turkey, other markets. It means that domestic mills are losing business to foreign suppliers. We see a significant distortion of global trade patterns, so mills which traditionally export to certain countries suddenly find their competitors which have a different pricing structure and aggressively enter a market. It will lead to more protectionism, and again, more protectionism means even more distortion of traditional trade patterns. Now, again, we do agree with Turkey that China is basically to blame for this. We see the continuation of record high production levels, whereas domestic demand really stopped growing. So, domestic oversupply is being exported to other markets, with not only volume effects, but also pricing effects, and due to the severe pricing effects, margins have come under even more significant pressure than they are already, because the EU is definitely suffering from higher energy prices, the cost of unilateral environmental controls, and overcapacity, which is there, we won't deny that in Europe, is being exacerbated by the import issue. Overcapacity is not only a European issue. Let me be very clear on that. It is definitely a global issue. But I think if you look at overcapacity, you have to realize whether overcapacity is cyclical or structural. If you look at the EU, going back in time to, let's say, the late 70s, we were seeing a situation where there definitely was too much structural capacity. Growth slowed down significantly after 2 oil crises, and drastic restructuring measures were taken by companies, by governments. In those days, the steel industry was largely state-owned. So some 100 million tons of capacity were taken out of the market, with severe repercussions for employment in the steel industry. We improved from there because the industry was then largely privatized, consolidated. But again, 2009, the global recession followed by the Eurozone crisis, again, we remain in a situation where capacity utilization is low. But again, Europe is trying to do what it should do. We've seen a further capacity reduction between 2008 and 2014 of 8 million tons. As it is, if you take effective capacity as, let's say, the key measure for measuring unused capacity, we will arrive in 2014 at some 25 to 30 million tons of unused capacity. We do expect that over the coming years, steel demand in Europe will increase modestly. So the issue of overcapacity will, to some extent, solve itself. But it is also true that in, let's say, certain parts of the market, particularly the long product producers which sell commodities into the construction sector, there's definitely probably the strongest problem to be addressed. So there will be further capacity closures in that sector. That's at least our expectation. Unfortunately, also very healthy capacity in Europe is currently suffering from unfair trade conditions from third countries, and I mentioned already the high cost of energy and the regulatory burdens in the EU. The final slide with the key messages for Europe. I think if you look at the fundamentals, indicators, data, there's definitely a case for a scenario of expecting, again, a moderate economic recovery in the EU. Nevertheless, downside risks are there, so the outlook remains vulnerable to those risks. On balance, we will see a slow recovery of steel demand, activity in the steel-using sectors. Divergence at the country level will remain to some extent, particularly with regards to steel-using sectors, but overall it should be slightly less significant than we've seen in recent years. Unfortunately, imports remain a key threat for the health of the European steel sector because it's leading to a significant increase in competition and continued margin pressure. And margin pressure means less investment in R&D, innovation, and the risk for Europe to lose its competitive edge in, for instance, product innovation, product development. Oops. And excess capacity is gradually going to reduce over the coming years. Okay, this is where my presentation ends. I'm willing to take any questions you could have.
Hello.
Hi.
Thank you for coming to our session. I just want to ask about anti-dumping this year. As we know, this year is called like anti-dumping year. And countries applied anti-dumping issues for protecting their local market. So anti-dumping is just like a tool of commerce for protecting their markets. Therefore, what do you think about, will anti-dumping be kind of a method for new solution in order to compete with other countries' markets, steel market, in this and next year?
Okay.
Thank you.
You know, it's an interesting question. First of all, anti-dumping measures in Europe are, let's say, something which are not so easy to get going. The situation in the United States is not different. I mean, we usually need the process of at least 1 year with a lot of proof that companies in Europe are facing injury from imports with respect to prices, so there has to be serious undercutting. The importing countries need to have a significant market share. So you need a lot of proof to get the process going, and even then, the decision by the European Commission will be a political one. So there's never a guarantee that the case will be rewarded. In the past few years, we haven't seen hardly any cases being rewarded. You mentioned anti-dumping measures at the country level, which do not exist. Anti-dumping measures are always taken at the EU level. So it's a tool which is being used very, very moderately. Because in Europe we believe in open markets. That's as simple as that. We would like to export to other countries as well. So if we close our borders, we would be doing exactly the same that we hold against others. Definitely there are some cases. Of course we are, as I mentioned in my presentation, we are worried about the trend in imports from certain countries. So at this point in time we are monitoring how these imports are behaving, and if, let's say, there is sufficient evidence, but we test it ourselves before we go to the European Commission, then we might decide on further action. There's currently only the revision of the wire rod case against China, which ended a couple of months ago. It's currently under revision. There's some cases in preparation, but as I said, it is extremely difficult in Europe to get any action from the European Commission with regards to trade protectionist measures.
Any other questions? There's one question.
Thank you very much for the presentation. It's Ahmet Soybaş from Soybaş Steel. My question is with regards the incentives, government incentives in Europe given to the steel factories, companies. As far as I know, if I'm not wrong, according to the European Steel and Coal Association, or the foundation, governments cannot make any, cannot give any incentives to the steel companies. But we saw some kind of incentives given to the Ilva factory in Italy, as far as I know. And I just wonder, in Turkey, as far as I know, as I say again, according to this agreement, Turkish government cannot make any incentives, cannot give any incentives to the Turkish steel factories. I want to understand if any incentives are given to the European producers by the European governments or not, and if they are giving incentives, why cannot Turkish government give incentives to the Turkish producers? Thank you very much.
There's a very simple rule in Europe which simply prohibits any incentives or subsidies being given to the steel industry. And that rule is still there. Actually, this year we've seen a revision of state aid rules, and again, the steel industry was excluded from basically all kind of subsidies. There's only one subsidy with regards to R&D, research and development, when it is related to projects which are in the overall interest of the steel industry. There is still one subsidy if there's a permanent closure of capacity, then let's say the social cost is going to get some incentives. For the rest, there are no incentives or subsidies. With regards to the latter part of your question about Turkish incentives, I would suggest you go to your own government and ask them why they are not willing to give any subsidies. I cannot answer that for you.
Okay, questions? Actually, Mr. Jeroen, I have one question for you. You are expecting an increase in steel demand in Europe. Do you think steel prices will be at sufficient levels to enable the profitable operation of electric arc furnace-based producers in Europe?
Yeah, actually, Mr. Yayan knows that. Actually, I'm not allowed to talk about prices. In all our meetings, we say we cannot discuss prices or volumes. But I'll give you some, let's say, comments about trends in the market which could lead to better or worse prices for steel producers in Europe. Scrap prices are, of course, a big problem at this point in time. This morning, the gap between iron ore prices and scrap was mentioned. Definitely, if you look at the health of steel producers in Europe, there's a significant difference between whether you are a producer BOF-based or EAF-based. That's a significant divergence. And having heard price forecasts of $55 to $60 per ton for iron ore, I would say that situation is going to last probably for the next year, maybe even a bit longer than that. So yes, it is clear that particularly EAF producers, and particularly if you're in the commodity business selling rebar or whatever, you're in a desperate need of seeing a better level of margins. But unfortunately, customers are also reading Steel Business Briefing and Metal Bulletin, and they're reading every day that prices are coming down, whether it is iron ore, coking coal, or scrap. And that's putting a lot of pressure on the other side of the negotiating table when you go to a client to ask for higher steel prices. They know about what's happening in industry, and it makes it very, very difficult to let's say, have any improvement in prices. So my estimate is that for the time being, particularly in the long product segment, the margins will remain, let's say, non-existing or very, very low.
Not bright then.
Nope. Nope.
Okay, thank you, Mr. Jeroen. Any other questions? Okay, I want to thank you once again for your informative presentation.
Okay.